Welcome back to Talk Tickers. It is Tuesday, January 27th, 2026. And if you're tuning in, you probably saw the after hours tape yesterday, or you've been glued to the screen all morning.
Yeah, you have.
We're looking at FirstSun Capital Bancorp, ticker FSUN.
It has been a very busy morning. The earnings dropped after the bell yesterday. That was the 26th. And management just wrapped up their call, about an hour ago, 11:00 a.m. Eastern.
And the market is definitely awake. I mean, we are seeing a lot of green. The stock closed today at $39 flat, which is up 3.15% on the day. That's about $1.19.
And that almost perfectly mirrors the after-hours action we saw last night. It's a very constructive reaction. The market clearly heard something it liked.
It feels like a relief rally, maybe mixed with some genuine surprise. So the mission today, I think, is simple. We need to figure out if this is just a lucky quarter or if FirstSun is actually executing on this whole quality compounder narrative they've been pitching. Yeah. Because looking at the headline numbers, they didn't just beat estimates. They kind of crushed them.
They absolutely did. This was a definitive beat. Let's start with EPS. Adjusted earnings per share came in at 95 cents.
95. And the street was where?
The consensus on the street was hovering somewhere between 82 and 86 cents. So, you're looking at a solid 9-cent beat on the bottom line.
That is significant for a regional. Usually in this sector, you are fighting for pennies. A 9-cent beat is a statement. What about the top line?
Revenue landed at $111.36 million against expectations of around $108 million.
So they're winning on both ends. This isn't just cutting your way to prosperity.
No, not at all. They are actually bringing more cash in the door than people expected.
But the number that made me actually sit up in my chair, and I think this is what the algos grabbed onto immediately, was the margin.
The net interest margin, or NM.
Exactly. In a world where every single bank is complaining about deposit costs squeezing them, where the whole narrative has been rates are high, funding is expensive.
Yeah.
FirstSun posts a tax equivalent NM of 4.18%. That's up 11 basis points from last quarter.
And, the context here is key. It's been above 4% for 13 consecutive quarters. That is it's rare consistency.
It really is.
We cover a lot of banks, and seeing a NIM handle that starts with a 4 is becoming an endangered species. Yeah. And then you look at the profitability ratios, ROAA at 1.34%, ROAE just under 14%. These are quality metrics.
And the efficiency rate.
Sitting right around 65%.
Okay, so immediate takeaway. This wasn't an accounting trick. This wasn't just, cutting the travel budget to save a penny.
No, this was a revenue and efficiency beat. It's operational excellence showing up on the spreadsheet.
All right, let's unpack that NM because 4.18% is a fantastic headline. But we need to know how the sausage is made. How are they expanding margins when the narrative for the last year has been funding costs are eating banks alive?
It really comes down to balance sheet plumbing. It's not the sexiest part of banking, but it's where the money is made. Yeah. Get this. Their interest-bearing deposit costs actually went down by 21 basis points this quarter.
Down. In this rate environment, that seems almost mathematically impossible unless you're just bleeding customers.
Well, they are shedding specific customers, and that's the whole point. But first, let's look at the debt side. They did some very, very strategic liability management. They redeemed $40 million in subordinated notes.
Which is usually your higher cost debt.
Exactly. And then they issued $100 million in senior notes. So by just reshuffling the deck chairs on their debt stack, they essentially refinanced themselves to lower their wholesale borrowing costs.
That's savvy. It's like refinancing your mortgage at the perfect time, but, on a corporate level. You just swap expensive debt for cheaper debt?
Precisely. But the deposit story is even more interesting, and honestly, it's the bigger driver here. Total deposits are up about 6.5% for the year, but the mix is shifting dramatically. They are intentionally letting consumer CD balances drop.
Which is so counterintuitive if you're just chasing growth, right?
Right.
I mean, usually banks are throwing out 5% CD offers just to get cash in the door, to show growth on the balance sheet.
Right, but that's what they call hot money. It's expensive. A customer who comes to you for a 5% CD isn't loyal to you, they're loyal to the 5%.
Yeah, if the bank down the street offers 5.1, they're gone.
They're gone. Rob Cafera, the CFO, was super clear on the call. He basically said they aren't chasing those high CD rates. They are letting the price-sensitive customers walk away.
So they can focus on what?
On the operating accounts, transaction accounts, money markets, sticky stuff.
So they're trading volume for margin, They'd rather have a slightly smaller, much cheaper pile of cash than a massive, expensive one.
And it is working. They mentioned their deposit betas, which is just a fancy measure of how much they have to raise rates when the Fed does, are tracking lighter than the historical 40% levels.
And that's the secret sauce.
That is the secret sauce to that 4.18% margin. They aren't passing on the full cost of higher rates to their deposit base because their deposit base is sticky businesses, not, rate-chasing individuals.
It's the difference between renting a customer and owning a relationship.
That's a great way to put it.
Okay, let's pivot to the other side of the balance sheet, the loans. Because you can have all the cheap deposits in the world, but if you aren't lending them out, you're not a bank.
You're a mattress.
Exactly.
And they are definitely lending. Average loan balances grew 8.5% annualized in Q4.
And Q4 is usually dead, right? I mean, everyone's on holiday, deal flow slows down, nobody wants to close a loan on December 28th.
Typically, yes, it's seasonally very slow for fundings, but their new fundings were up 30% year over year. They funded about $350 million in new loans.
And what kind of loans are we talking about?
Importantly, this isn't just real estate. This is commercial and industrial C&I lending.
Which is harder to get. C&I is sort of the holy grail because it usually comes with those sticky operating deposits we just talked about.
Correct. If you lend to a business for their new equipment, you usually get their checking account too.
Which brings us to my favorite part of the call, the geography. The CEO, Neil Arnold, made a comment that I think explains the entire strategy. He called the Texas M&A market
white hot.
White hot. That phrase really stood out. But he didn't mean we're going to go buy a bunch of Texas banks.
No, he meant the exact opposite.
Right. The logic is fascinating.
It is, because the Texas market is so chaotic with mergers right now, banks buying other banks, distraction, integration headaches. FirstSun is using that chaos to poach talent.
I love this. Let's just walk through this for a second. So you have Bank A buying Bank B. The bankers at Bank B are suddenly dealing with new bosses, new software.
Their commission structure probably changes.
Right. They're annoyed. They're stuck in meetings all day instead of being out there selling.
And then FirstSun swoops in. They aren't trying to buy Bank B. They just call up the top 3 lending teams at Bank B and say, hey, come work for us. We're stable, we're growing, and we want you to bring your entire book of business.
It's organic growth disguised as M&A arbitrage. They're hiring teams in Dallas and Houston instead of paying a huge premium to acquire their banks.
And just think about the economics of that. When you buy a bank, you pay goodwill, a premium. When you hire a team, you just pay salaries and bonuses.
Right.
Arnold was very specific that they are seeing opportunities to pick up these revenue-generating bankers for, relatively speaking, free.
Just because of all the disruption.
Exactly.
They mentioned Southern California too, but the tone on Texas felt much more aggressive.
Oh, it did. Texas is the battlefield right now.
Yeah.
And if you can grow your loans at 8.5% just by hiring frustrated bankers from your competitors, that's very high return strategy. It avoids all the integration risk of a full merger.
Now, speaking of M&A and integration risk, we have to talk about the elephant in the room, the First Foundation merger.
Sure.
We know the definitive joint proxy was filed January 15th. They're expecting to close sometime mid-2026. What's the latest vibe on this?
Well, the strategic rationale hasn't changed, but the confidence seems higher. This is a, quote, balance sheet optimization play. First Foundation has a lot of term assets.
So loans locked in for a while.
Right, and they have short funding. It's a classic mismatch.
A painful one.
A very painful one. FirstSun is essentially coming in to fix the plumbing, but there was a nuance on the call today about the hidden gem in First Foundation's portfolio.
The multifamily portfolio.
Exactly. Historically, people look at multifamily loans and they just worry about credit risk or rent controls. They think about the bricks and mortar. But FirstSun is looking at the borrowers.
The investors.
These are real estate investors. They are sitting on cash.
And FirstSun wants that cash.
They want to cross-sell treasury management services to these multifamily owners. They want to become the primary operating bank for these landlords. If they can pull that off, they bring in tons of low-cost deposits to fund those loans, which fixes the entire margin issue at First Foundation.
The same playbook they're using right now. Dumping expensive CVs, replacing them with operating accounts. They're just applying it to a much bigger target.
That is the whole thesis. It's not about the buildings. It's about the liquidity that the owners of those buildings hold. If FirstSun can capture that liquidity, the merger becomes a massive, massive win.
Okay, let's talk guidance. They gave us a look at 2026 standalone basis. What are we modeling here?
They're looking for mid-single-digit growth in net interest income. For fee income, so treasury management, mortgage, they're targeting low double-digit to low teens growth.
That feels, I don't know, optimistic, but doable given the Q4 momentum. What about their macro assumptions?
Their model assumes 2 Fed rate cuts in 2026, which is pretty aligned with the consensus view right now.
Okay, what about the risks? We did see a charge-off this quarter, a telecom loan.
Yes, there was a specific charge-off related to a telecom credit. It had been partially charged off before, but they took the rest of the pain this quarter. It made the credit metrics look a little lumpy.
Lumpy was the word Neil Arnold used, wasn't it?
It was, and it's a fair description of C&I lending. It's not as smooth as a mortgage book. You have fewer, much larger loans, so when one goes bad, it really shows up.
So is it a problem?
Management was very firm. There are no pervasive credit issues. They expect net charge-offs to be in the mid to high 20s basis points for 2026.
So manageable, just lumpy.
Manageable, I think, if the efficiency ratio stays at 65%, you can afford a few lumps if your operating engine is lean. If that efficiency ratio starts creeping up to 70, 75%, then those charge-offs become a real problem. But right now, that profitability buffer is there.
So bringing this all back to the listener, why does this all matter right now?
I call FSUN the idler gear compounder. If you look at the sector, the KRE, the regional banking ETF, is up about 7% over the last 12 months. FSUN has actually lagged a little on a 52-week basis, down about 5%.
But it's up nearly 30% in just the last few months.
Correct. It's catching up. The pivot is happening now. This quarter proves they can compound earnings through the cycle. For a while, investors have been sitting on their hands just waiting for the First Foundation merger to execute.
Right, the merger is the big if. It creates a lot of uncertainty.
But these strong, standalone results provide a floor. Even if the merger gets delayed or, it's messy, the core FirstSun engine is printing a 4.18% IM.
So that protects the downside.
It protects the downside while you wait for the merger synergies to create the upside, the ceiling. It's a really nice setup. You basically get paid to wait.
I like that.
Yeah.
All right. We've covered the beat, the margin magic, the Texas talent war, and the merger plumbing. Now, time for the segment that our legal team loves to hate.
The disclaimer segment.
This is emphatically not financial advice. We are two voices on a recording. We do not know your portfolio, your risk tolerance, or your grandma's retirement plan.
Please do your own diligence.
Dud. If you were a hedge fund analyst pitching a wild idea to the investment committee based on this call, what is the trade?
I'm calling this one the Texas poach and arbitrage pair trade.
Okay, I'm listening. Break it down.
The setup is pretty simple. We go long FSUN, and we go short a basket of CD-heavy Texas regional banks.
Ooh, fighting words. You're picking a fight with the neighbors. What's the logic?
It's two-pronged. First, the talent arbitrage. We just talked about it. The Texas market is in M&A chaos. FirstSun is getting these revenue-generating bankers for free by hiring them away from distracted competitors.
So the competitors are losing their rainmakers.
Exactly. While FirstSun gets the revenue without paying the acquisition premium, you're betting on a brain drain from the competitors straight to FirstSun.
Okay, prong one. What's prong two?
Prong two is the funding cost divergence. We short the banks that are currently desperate, the ones paying 5% or more on CDs to fund their loans because they don't have treasury management capabilities. And we long FSUN, which just proved today that it can lower its funding costs by dumping those very same CDs.
So you're shorting hot money dependence and you're longing sticky money discipline.
You got it. As rates eventually come down, the banks with the sticky operating accounts will keep their margin. The banks addicted to high-rate CDs will get squeezed or lose the deposits entirely as customers chase yield somewhere else.
And the kicker. There's always a kicker.
The wild kicker is the merger timing. You bet that the First Foundation merger closes early. And if they execute that balance sheet optimization immediately, fixing the plumbing we talked about, you could see an immediate 20 basis point NIM expansion on the combined bank.
Which would absolutely squeeze the shorts who think the merger is going to be a drag on earnings.
It's a squeeze play on the skeptics, funded by the efficiency of the Texas poach.
I like it. It's aggressive, it's geographic, and it plays the plumbing.
That's where the alpha is.
All right, let's wrap this up. Recap for the road.
FirstSun delivered a clean beat on the top and bottom line. They expanded margins to 4.18% in a really tough environment, and they are growing loans at 8.5% by hiring talent, not overpaying for banks.
And that lumpy credit excuse.
It's valid if, and this is a big if, they keep delivering on that 65% efficiency ratio. For this quarter, I'd say they've earned the benefit of the doubt.
There you have it. The market likes it, the margin is healthy, and the Texas teams are hiring. Do your own homework, check the filings, and we will see you on the next ticker.
Thanks for listening.